All right. Thanks for joining us, gentlemen. Doesn't look like we've got anybody else right now. We've got Logan Lee with us, and then Paul Coffin is also here, and then of course John Stark. So the plan is if y'all have any specific questions that you would like to ask about the Moody REIT, your investment specifically, just feel free to unmute yourself, or you can use the chat and ask that question, and then Logan and Paul are going to answer your questions to the best of their ability, and then also give you any additional information that they might feel is pertinent. So yeah.
Hit it, Logan.
Sure. I'll just start real quick. First of all, thank you for taking the time to join us today. It has been quite a year, and I want to say thank you, first of all, for your trust and your investment. Nobody signed up for this. No one signed up for what you've been through, and we're so grateful for your patience in this past year of disruption. First of all, by way of introduction, I've been at Moody for 16 years. And so this is not my first experience with respect to a decline in hotels. We had a significant portfolio heading into the 08-09 Great Recession. And at that time, we saw RevPAR, which is your benchmark metric in hotels. It's your revenue per available room, combines your rate and your occupancy. So we saw RevPAR nationwide decline about 17%, which was the worst on record at the time since the Great Depression. And so we had to navigate through that. Unfortunately, in our portfolio at that time, we were highly levered. And so this time around, we learned a lot of lessons from our past experience. And although no one could really train you up on what to endure through a global pandemic like we've experienced. Obviously, this is we're interacting on Zoom. Many of us, this is the first experience we've had of this kind of thing. But to put it in perspective, last year, remember how I said RevPAR was 17%, which is the worst since the Great Depression. In 2020, RevPAR nationwide declined 45.7%. Just a dramatic drop, which is the worst on record that we've ever experienced as an industry. And so when demand, of course, is Murphy's Law, as soon as I start, the dog starts barking. Sorry about that. And so we've had to navigate, and I will say this, I'm very proud of our team to make really tough decisions, but they were the wise courses of action. We immediately stayed open, whereas a lot of our competitors just shut down the hotels. We made the decision to stay open and to shut down, instead of shut down hotels, we would shut down floors. We also had the misfortune, or it was a fortunate timing, to have our Spring Hill Suites downtown Seattle asset. We felt the pain first as a result of having a significant asset in Seattle. As you may recall, the pandemic hit Seattle first. So we had the taste of the pandemic before a lot of others did. So we made quick choices that were decisive, that were the right choices. We shut down floors, we shut down expenses. We made massive layoffs just to prepare for what we suspect was going to be a long time to have these lockdowns and to have demand shut down as it did. Which is involving you, right? The board came together and made the tough decision, but the right decision, to shut down the offering, shut down the distributions, suspend the share repurchase program, basically doing all that we can to preserve and protect your equity and to preserve and protect the assets in the process. We hate it. We know that this was an income product. It was one of the highest distribution products there was in the space, and it was on its way doing really well in 2020. And then of course things took a dramatic change with the pandemic. Really proud of our team, though. We got first responder business. We got our National Guard business. We made the approach of aggressively pursuing whatever business during the onset of the pandemic, and it proved to be very fruitful. So it generated some revenue, so we could pay some expenses. Meanwhile, our asset management team worked tirelessly to get obtain loan modifications on all the 15 hotels. So proud to say that our team worked around the clock to do this. We started the process really early, which was also fortuitous. So we were able to obtain all 15 loan modifications. A couple of hotels now do not need any more modifications. They're paying their bills on time. They're paying their mortgage on time. That's good. And then we're seeing revenues increase across the portfolio, fast forwarding into 2021. So I just want to say thank you. I wanted to start off on the tone that we are so grateful. We know that no one, like I said, no one signed up for this, and we're hopeful for as things continue to improve. We're watching the Delta variant very closely, but as of yet, we have not seen it impact our hotels. So we're hopeful that our travelers will be resilient as vaccinations continue to increase. People will be resilient to travel. We're very, very fortunate to be in travel markets. We're in Austin, Dallas, Charleston, South Carolina, Nashville, Seattle. We are so thankful that we are in these markets where tourists are traveling to, because we're not seeing the business travel that we did in 2019. So anyway, I just wanted to start off with that, say thank you. We're so sorry that this happened. We are working our tails off to preserve and protect your equity, and then also to get to a point where we're paying distributions again, which is why you invested in this thing in the first place. So anyway, with that, I thought it'd be best and more fruitful if I just could address your questions. And I've got Paul Coffin, my colleague, on the line as well. Both of us are happy to address any questions you may have.
Anybody have questions?
This is Scott Bailey. Just a quick question on distributions. When does that plan to restart?
Great question. So what we had to do, I didn't finish my thought. Thanks for bringing that up. The first go around in 2008, 2009, we were highly levered. And this time around, we were, very, very much definitively de-levering our portfolio. And it proved to be very, very, very fortunate. So we ended up heading into the pandemic at 45% leveraged, which is very conservative. And as a result of that, working out the modifications has been much easier. And so, but part of that is we worked out, a deferral of interest payments, and we had four born amounts of our loans, and so we have to pay that back before we're able to start distributions. It also puts us in better position to control the cash, because a lot of our modification agreements, the lender has control of the cash, and that's just part of it. And so once we get current on our loans, the next phase is to pursue distributions. So on that note, Moody National, our parent company, it's actually Moody National Capital, stepped in and put in an additional $10 million into the REIT to accelerate and pay back the deferred interest payments from 2020 on a lot of these loans. We're not out of the weeds just yet. We are pursuing and in discussions with other lenders to get another, what we foresee as an additional loan credit facility to pay back our forborne amounts, so that we can then get back to ground level. And then as the properties start producing, we can look to do distributions. So all that to say is, I don't know exactly when. My guess is it'll be if we are able to do distributions, we'll look to do that after we pay that next balance of the credit facility. We suspect that while Moody will be lenient on its 10 million, the institution that we receive another credit facility will need to get paid back first before we're able to issue distributions. The revenues of the properties are getting better, but we're still not to the point yet where everything collectively is generating revenues to pay debt service, expenses, and then having excess after that to pay distributions to investors. So even if all the loans were paid back and we were current, we're still not quite to the point where we can pencil out any distribution right this second, although it's getting much, much better. So I would just say, let's see where we are at the end of the year. And then hopefully starting some point in the next year, when revenues continue to climb, we will absolutely look to do distribution. I'll also say the fact that I'm saying this right now is amazing compared to where we were at the onset of the pandemic. We were just emergency mode trying to preserve the assets. And we're so excited to come through with all 15 hotels in good condition, revenues increasing, travel and demand are increasing. So we're in good shape. Your investment is good in those 15 properties. I tell people all the time, like, what is the value? What's going on? Like we have all 15 hotels and revenues are increasing. That's tremendous through the worst performing hotel market we've ever seen. We couldn't even imagine how bad it was. So I don't know is the answer on distributions, but I just know the steps we have to get, we have to clear in order to get to that level. And we're not there just yet, but that 10 million investment from Moody is a good first step to where we could start getting current on our loans and then control the cash. So then we can do distributions.
Thanks, Logan. Sorry, I actually meant to thank John and Andrea and yourself for setting up and participating in the meeting. So appreciate the information. One quick follow-up. Because of the pandemic and people working from home, some percentage of those employees are now permanently working from home. Are you seeing that affecting the revenue stream as we get back to more normal times?
We're seeing the business travel just yet, but what we are seeing is explosion of SMRF. We call it SMRF demand: social, military, educational, religious, and fraternal. So basically everything that's non-business. We have seen an absolute explosion of that, particularly in Austin, Dallas, and Nashville. We're starting to see a tick up in Seattle as well, which we're excited about. So I agree with what you're saying, and we're definitely seeing it, that business accounts, for example, in our Seattle, our number one account is Amazon, and Amazon just committed to keeping people at home through 2022. I don't know if you guys saw that, but we're definitely feeling an impact, but it's been significantly backfilled by SMRF demand. I talked to someone the other day who was trying to get on a flight to Nashville, and the cheapest ticket was $1,300 over Labor Day weekend. It's just insane because everyone's wedding. Think about it, all the weddings have been postponed to this year, all the events, so there's a lot of social stuff and, baseball teams and stuff like that. That's really, really impacting demand in a positive way. The problem is the rate. We're slower. You can't quite get the rate that you once had, but it's getting much better. So we're hopeful that in the fall, when school's back in session, that we'll see some business travel. At least your not your big corporate travel, but you'll see you'll see your individual business meetings. Like, for example, Paul Coffin, who's on the Zoom call, he and I've talked, and he's going to go travel. He's going to go see some people. So you're going to see your onesie and twosie travel, but for business, but you're not going to see your Microsoft or Amazon accounts just yet. Hopefully that'll really be the gravy on top of things in 2022 and beyond.
And Logan, let me interject here. There's still a number of competitors to you. I mean, in the alternative investment space, they're still not let the wholesalers travel. And I talked to one yesterday that they were going to let them travel, but they reiterated because of the Delta variant, they stopped them from traveling now. And he said he'd get back to me. It could be another month or more. So it's still across the board. Yeah,
good point. But you're seeing a lot of these business travelers traveling. They're business travelers traveling on leisure. If most of your Smurf business are your business travelers traveling with their family. Mm-hmm. So it is happening, but not so much on your business card.
Anybody else?
Thank you.
Yeah, this is Tom. Can you hear me?
Yes, sir.
Yeah, a couple of things, and one is maybe a follow-up from what John just mentioned. I've heard that I saw an article about Southwest Airlines experiencing a reduction in customers due to the Delta variants. Are we seeing that else now, and what do we expect that to do to us in the coming months?
Great question. We have yet to see it impact our hotels. It's still a little bit early. I put in the question, how are we doing with the Delta variant? And I would say that we're not airline focused as others. We have regional destinations that are accessible very much by drive-in demand. Not ideal though. You definitely track TSA foot traffic, and it does correspond to hotel room night demand. But as a result of being in Nashville and Austin and Dallas, these are to a lesser extent impacted by lack of airline demand. I think people are comfortable driving to a hotel. You should see the amount of precautions that we do and that we have to do with Marriott, Hilton, and Hyatt. It's unbelievable. You basically don't touch anything. You walk in and you have a keyless entry to your door, and your room is spotless and clean. But then there's all kinds of precautions to make sure you feel safe and sanitized and so on. So I think people are driving into our hotels if they're not going to fly. Luckily, like I said, we're in those pretty resilient travel markets. But it's a little too early to tell. I haven't quite seen in our numbers just yet a decline due to the Delta variant. I'm sure there's some, but it's not impacting us just yet to the degree that you would think.
Okay, and one other question. I understand that there's going to be an appraisal soon of the various hotels in the portfolio. What do we expect that to do to our stock price?
Well, it's a great question, Tom. Our board made another tough decision last year to not value. The reasons were it's the worst hotel market on record, and there is no market. That's the most important thing. The only trades that were happening last year were fire sales or foreclosures. And we discussed with our appraiser, we discussed with the board, and we did not think it was an appropriate time to spend, upwards of $500,000 or more on appraisals that mean nothing. They mean nothing because we're not going to be selling anything, one, and two, we're not selling shares. You need to value. FINRA makes you value every year as a disclosure rule so that customers know what the value is as they're buying shares. Well, we've suspended the offering. We're not selling any shares. So we're not going to sell the assets. It's the worst market ever. And we're not going to be selling shares. And every penny is absolutely crucial for the portfolio. So we're not going to spend $500,000 or more on appraisals, right? So they came to that conclusion. And we did not realize the pain that would cause with respect to custodian accounts like Pershing and others, where they don't take our number. They just say, well, the REIT has not value on their customer account statements on their online views. That created a lot of panic, as you can understand, and a lot of confusion. And we just keep telling people, no, we've got all 15. I agree. I'm so sorry. It's like, hey, we've got all 15 properties. They're generating revenues. It's certainly not zero. So I'm optimistic. We just saw a hotel trade in Austin at $265,000 a key, which is like pre-pandemic numbers. So that's good for our comps. So I'm hopeful that we'll get a decent valuation. But I want to encourage you guys to not, we're not going to sell. We're not selling today. It's just a paper statement of what the appraisers are thinking. So whatever it is, I would encourage no one to make any determinations based on that. We're coming off the worst year on record. So keep that in mind. We're not going to sell the portfolio at this time. So I would just hang on. So the answer is, I don't know what it was going to be. I would suspect it's not going to be the same as it was in 2019 based on, where the revenues were at that time. But again, we're not doing anything. We're not selling at this. If it's a lower number, we're not going to sell now. That's why it's a real estate investment. We're going to be smart and sell it when things come up a little bit. So anyway, just be patient on that number, but we do have to value, and the board is in discussions with the appraisers now. I would suspect it would come in the first quarter. They'll do the appraisals at the end of the year, and then we'll post it in our first quarter reports. And so until then, we're just going to provide, hopefully I want to encourage you guys to get on our website, moodynationalreit.com. Again, that's moodynationalreit.com. And we have video messages from our CEO. So we're going to provide video updates every quarter. We're looking to do property snapshots on a monthly basis going forward. So you can just kind of get an idea of what each individual asset is doing, provide updates there. Just to, again, reiterate the fact that it is not zero. You have 15 hotels in the portfolio that have withstood the recession, the greatest recession in hotels that we've ever seen. That's you've got assets. So it's definitely not zero. So sorry, long-winded way to answer your question. That it will have to do a paper valuation in accordance to the FINRA rule by year end, and then we'll post it in the first quarter.
Thank you.
Anybody else? Well, Logan, one quick question I'll have myself. I know most of your revenue now is from the traveler, the social traveler. What is your occupancy now, even with those guys?
We're at about 73%. That was our month end number. And this is what's important to know, okay? Our occupancy in 2019 was 75%. Here's the big difference. Our rate was about $150. Our average daily rate was about $150 in 2019. And so far this year, we're right at about $100, right? So significant discount to your rate. So occupancy can be right where it was, but your rate is certainly declined. And by the way, that's not a weighted average. That's just a general average across the portfolio. Right at about 90 to $100 is our rate, which is, $60 or so off collectively from where we were in 2019. The big indicator is your revenue per available room. It's down on average about 45% from 2019 peak. So we were at 105 or a little over $100 RevPAR in 2019, and last month we hit 82. So we're still 25% off on RevPAR. So that's what we really need to see. We need to see our rate increase, because occupancy is great, but you got to get that rate up in order to be profitable.
Gotcha.
John, I have a question.
Yeah, John.
Okay, great information so far. The loan modifications, first of all, the 10 million, does that have to be paid back to Moody?
Yes. Yes, it is a loan. We have disclosed in our filing. I'm happy to send it out to John. We have a filing that discloses all the information. We're at about, I think it's about a 5% rate, which is extremely favorable compared to, some of these hard money lenders, if you will. You're looking at 15 to 18%. So yes, it does, but we're not going to, it's up to the board, but our indication is that it's not going to interfere with distributions. In other words, if we're able to pay the interest payment, we're not going to make the REIT company pay back the loan before we do investor distributions. That's at least that's where we're standing right now, unless the board changes its mind. But it's up to us. I think we're the lender. So yes, it will eventually need to be paid back. But imagine it being a pretty good investment, pretty good shot in the arm for the REIT that it needs.
Yeah. When do you see the loan modification exiting? Sometimes next year.
Yeah, this year. I'm hopeful we'll get out of everything by the end of this year.
Perfect.
Yes, like I said, I mean, we've got 2 properties that are self-sustaining. We're on our way with 2 more. So things are, we just got to pray this Delta variant doesn't throw it off and that we take 2 steps back after we've already taken so many steps forward. We finally have momentum, so I don't think it will. Like I said, in the markets we're in, or like I said, resilient. But that's the only wild card I just can't project is what's going to happen with the Delta variant. I like what you're looking at Europe, it peaked out. And so I'm hopeful that like this, coming up soon, we'll peak out and vaccination rates will increase some more. And we'll see big time fall. We're hoping for a big fall with demand. That's what the prognosticators are saying at any rate. So we'll see.
Anybody else? Well, Logan, I really appreciate you taking the time. I had the benefit, as I told a few of my clients, that had the benefit of listening to you in San Antonio and hearing the prognostications you had then. And like I said, I was very upbeat with how you survived and all that. And unfortunately, as you see, my client, Scott Bailey, had a full head of hair and had a black beard when I met him. And John Walsh had black hair. And Tom Glosser had black hair. So they've heard a lot this year. And Andrea has been dyeing hers. So we've had a lot of worries this year and all that. But that being said, though, knowing how you guys have buckled up and fought the good fight, I really appreciate you keeping us abreast like this. And I think this has been very productive doing this webinar. And the bottom line is, and like I said, and everybody, please go to the website, like Logan said, because you have a lot of information on that with snapshots of the hotels and recent updates on revenues and all that too.
That's right.
I'll be sure to send
well
everyone
said.
a recording of this as well. We will. This whole conversation has been recorded, so you'll be able to look back at this, and if you miss anything or forgot something, and then also don't forget that Logan mentioned MoodyNationalREIT.com. They have tons of updates on there weekly. And so you'll be able to continue to get additional information even if we don't host another one of these webinars.
Well, thank you for your time. Again, thank you all for your patience. And we're all invested in this together. And we don't take it lightly that you guys have been counting on income that has not happened. So we're fighting so hard to get back and get on track and put the pandemic in the rearview mirror, right? So we can really see some growth in the portfolio. So we're optimistic that'll happen. So thank you.
Thank you, Logan. Appreciate it. Thank you for everybody for signing on tonight.
Absolutely.
Yeah. Thanks, John and Andrea. Appreciate the transparency, Logan.
Absolutely.
Thanks.
We're glad you were able to join us, Scott. Mr. Wash, Tom, Mark, thank you as well. Paul, sorry we didn't get to see you or speak to you, but thank you for being in. And if anybody else, if you have questions, please don't hesitate to tell us. We can always reach out to Logan and Paul very easily. You know, we want to keep you as informed as possible.
And we do plan to do this again before the end of the year too.
Yeah, sounds good.
We'll let
Yep,
you know.
it does
when
sound good. So thank you.
Thanks, guys. Bye.
Very welcome. Y'all have a great night.
Thanks.
Bye.